Good morning, everybody, and welcome to this webinar, which is about navigating the legal aspects of a funding round. Before we start properly, there is some housekeeping. As I was saying a few moments ago, there are lots of attendees, so please, if you have any questions, put them in the chat, and we will try to respond to the questions at the end of the webinar. Please keep your camera off and also your microphone muted. That would be very helpful. And also, if at the end I've not answered your question that was in the chat and you'd perhaps like to discuss something which relates to the company and you don't want to have publicly discussed, there'll be an opportunity to book in for a kind of complimentary chat with me, which will circulate with the slides and hopefully with the recording as well. So without further ado, I'm going to start giving you this presentation, which is about the legal aspects of a funding round and navigating them. And there are going to be several themes which are woven together in this presentation as we think about the journey really of founders, and I assume most of you are founders, traveling from one funding round of the company to the next, and in a sense navigating from one destination to the next, and we hope obviously not through too many choppy waters on the way, with investors who join you at each destination, and in the end hopefully you'll reach the island of your choice, and we're going to help you, guide you through general principles that allow you to do so. And in doing that, we're also going to focus on a couple of themes, which are funding rounds actually as sales processes, because they are sales processes, and how that sales process and the company itself relates to the founder, and particularly the founding team, in relation to investors, and how best to structure each of the funding rounds, I should say, or probably all of them, because the principles are generally applicable. So let's start off with the first of those things then, really. So this is the start of our journey, really, and we're going to think a little bit about negotiation strategies in relation to funding rounds and where they come from and what they relate to. You're all here because you're probably part of the founding team of a private company, a startup. You might be an investor, but I imagine that most of you are in that situation. You're founders of a company. You have a startup. It's a private limited company. But why am I focusing on this in particular in relation to funding rounds? Well, I suppose it's because it's easy to forget the wonderful advantages that this legal invention gives you. A limited company allows outside shareholders to invest in the company in return for shares. But from your point of view, at the start of the journey or before the start of the journey, what's the great advantage of a limited company? Why is it so attractive? Well, the answer is it's limited your liability as a founder. It's limited your liability actually to the share capital that you have put into the company or have said that you will put into the company. So it's important, if you're thinking about incorporating a company and you haven't done so yet, to keep its share capital as low as possible. And the private company is a legal person. Lawyers have strange ideas about what a person is, and a company is a legal person. And obviously, unlike people, it's not mortal, can continue to exist for a very long time, and it allows people. It's a mechanism by which people can invest in businesses they want to invest in, and it allows you as the founders to limit your liability. So you're taking so much less risk than you would do if you were trying to create a large business without a limited company to do that through. So you've got the limited liability that the limited company affords you. So in this journey, as you go from one funding round to the next, try to avoid adding personal liability, when the whole purpose really of the limited company is to make sure you don't have it. So we're going to try to help you steer clear of personal liability. Now, as this section really is the background to a degree and thinking about your relationship with the company, we need to think about what your actual relationship with the company is. And I imagine many of you listening are actually thinking, well, I'm number two, I'm a shareholder. Yeah, I'm sure that's right. And I'm sure that many of you are the founding shareholders, but you're probably also very clearly number one as well. You're the directors. And so we're going to think about how you think about funding roles from these two perspectives, really, in relation to how you navigate the funding round. And really, we can split this off into two things. So as a shareholder, you are going to be thinking about your equity and how much it's going to be diluted by funding rounds. But as a director, you're going to be thinking about your business plans for the company, your projections for its performance, and running the company in the interests of all of the current shareholders, which is, of course, what you should be doing. It's important to make these distinctions because particularly if you're at the beginning of your journey with your new business, it's the first time you've ever had a startup. Some people, you may be sitting there thinking, well, actually, I control the company because I'm a shareholder and I have, say, 60% of the shares myself or 70% of the shares, or the founding team and I own 70% between us, therefore we control the company. That's not actually right, really. Directors are the people who control the company, not the shareholders day to day. So you need to think about that and think about that in relation also to, if this is not your first round, what your existing documentation, your shareholders agreement, for example, says about issuing new shares and the possibilities of further funding rounds. So if this isn't the first funding round you're thinking about, if it's a second, third, fourth funding round, before you start, you need to check where you are and what you need to do to satisfy your current obligations. But before we skip on further, in relation to your company, you might also be a lender to it, and you might also be a borrower from it. And all of these roles are important to consider as you move forward. Now, as we start to think about the funding round as a sales process, you really need to think about what you're selling. So what you're selling is the opportunity to investors to buy into the success of the company. So they're not buying into the company as it is now. They are buying into your vision of the company, which you will have presented to them probably in some kind of pitch deck with projections of financial performance of the business, which will be achieved if the investors invest and the company raises sufficient money in the funding round. So really, it's key at the beginning to think about pricing your round properly and not undervaluing the company particularly. That's a mistake we frequently see with new founders, undervaluing the company. Therefore, investors and actually indeed team members who are getting sweat shares, getting too large a percentage of the share capital too early and diluting the founder too much. There's nothing more disincentivizing for a founder or a founding team than actually realizing they've disposed of too great a percentage of the share capital of the company early in its journey. And so if you're not a financial person, you don't have the financial background to do this confidently, what you should be doing is speaking to your accountants, or even if your accountants themselves aren't specialists in doing this, find somebody who can help you with the valuation, because pricing clearly is the key part of this sales process. You've got to know the price, the value of the thing that the investors are buying into. So I'm assuming that really most of the rounds you're going to be doing are seed rounds and pre-A rounds, although some of you may be moving on to an A round. People say, well, what's an A round? To a degree, an A round's in the eye of the beholder. It's the round which allows you to properly and firmly establish the company, gives the company the money it needs to do what it really wants to do. But they come in different sizes, so you can't really, I think, pin an amount of money on them. It's more what they achieve for the company. And in each of the rounds, as you advance through the round, so you've thought about your valuation already, and so you then begin to think about documentation. And there's the documentation you should have in place already if you've done a previous round, shareholders agreement, for example. But if this is your first round, your seed round, and you don't have a shareholders agreement, it's a good idea to put in place your shareholders agreement with the company before the funding round. So it may be just you and the company. You only need 2 people. So the company's a person. If you own all the shares, you can have a shareholders agreement with it. If there's a small founding team, you can have a shareholders agreement with the company. And the advantage of doing this is that you keep control of the documentation, and you can say to your incoming investors, if you'd like to invest in the funding round, you're going to be signing up to this shareholders agreement, and there'll be a mechanism by which you do it, which is a subscription agreement. So if you are starting from scratch, don't wait, or try to avoid waiting until contact with the potential investors before you put in place your shareholders agreement, because they're very likely to say to you, oh, I've done 10 of these investments. This is a shareholders agreement I'm really happy with. I'll send it over to you. Perhaps you can just sign up to that. It's generally not going to be a good idea, because it's going to probably give much too much influence to the incoming investors at a small round. So really, in seed rounds, we like to think that founders are going to basically keep control. So in seed rounds, we prefer the outcome to be more or less still founders' dictatorship, basically. As investors invest, yes, they get put in the money, they get the agreed number of shares, but they don't really get control. Sometimes in early rounds, you don't actually have an investment agreement to cover an entire round with multiple investors. Sometimes you can manage to do this with separate subscription agreements, with people simply signing up to the shareholders agreement. So at least in an early seed rounds, that's probably preferable if you can achieve it. Obviously, you have to try to time the main closing so everybody gets their shares at once, but you can, of course, have multiple closings within the round if you want to, and that's whether you have one subscription agreement for the entire round or you have multiple subscription agreements. So the message really is, in early rounds, try to keep the documentation simple, try to keep control of it, but keeping control of it is going to be a theme that runs through this webinar. So if we're beginning to think about preparing for our sales process, what shouldn't we overlook? And the answer is yes, it's a sales process. The directors of the company are causing the company to offer shares to potential investors, and then eventually to issue those shares to the potential investors. But you shouldn't overlook the fact that issuing shares in a limited company, a private limited company, is actually regulated. And some people, when I say this, say to me, well, how's that the case? And I'm just about to explain. So there are things called the financial promotion regulations, and actually offering shares in a private limited company to somebody is a financial promotion, as defined in the regulations. You don't want to breach the financial promotion regulations if you can at all help it. Obviously, you want to comply with them, and so the first step with compliance is being aware of what they are. But perhaps more importantly, really, than the financial promotions regulations, which appear on the right here, and with a reference to Section 21 of the Financial Services and Markets Act, is the fundamental basics. So in relation to going back to basics, we were talking about your relationship with the company. You should also think about, well, what the company is. So a few slides ago, I said it's a limited company, it's a startup. But I should also have said it's a private limited company. And one of the keys to private limited companies is as usual, it says it on the tin, it's supposed to be private. So there's a prohibition under Section 755 of the Companies Act on private companies from issuing shares to the public. And you're maybe sitting there thinking, well, some of you might be thinking, well, that's obvious, I knew that, and I hope that's the case. And other people would be thinking, well, if that's the case, how do we issue shares? Well, public offerings are prohibited. So public offerings are really anything which can be understood as just offering shares to the world at large. So I can give you an easy example of what you shouldn't do. The other day, I received big sum in the startup world. I received an email from a company I'd never heard of, which seems to be coming from the directors of the company, offering me the opportunity to invest in shares in their company. I'd never heard of these people before, didn't know where they got my email address from. That kind of activity, I would say, is pretty clearly in breach of Section 755 if they're doing it to a very large group of people, which I assume they must have been. So if you're thinking about, for example, taking your entire mailing list or every single LinkedIn connection you've got, or all of your contacts on Facebook and contacting them saying, if you want to invest this much in my company, we can, you're going to get this many shares, or we can talk about the share price, or we can talk about the percentage of the share capital you're going to own. I think there's a pretty clear chance of actually falling foul of Section 55. So try to avoid anything like that. So avoid any communications with large groups of people remotely, particularly if you don't know who they are. They're just a list of people. You're going to be breaking this fundamental rule. Let's moving on from that, though, more nuanced is financial promotions, because the financial promotion regulations govern the way in which you should be doing this, because clearly private companies limited by shares are able to offer shares to people. It's just that doing so is controlled. So what is a financial promotion? So as you can see from the screen, it's any one of these things. So you can see that it can be made in in a variety of ways: face-to-face, a letter, an email, a posting on a website. Oh, before I move on, I actually think that in terms of making offers to the public, a posting on your website, which was pretty specific about the kind of funding rounds you wanted to do, would probably also be in breach of Section 755. But I digress slightly because that was the previous slide. But so if you're thinking about what you typically do in a funding round, so you can see that your typical activities as part of this sales process are going to be financial promotions. Don't worry too much, though. If you see at the bottom, you can see that you can make a financial promotion, but they need to be either made by an authorized person or approved by an authorized person or exempt. And if you're sitting there thinking, oh, great, authorized people can do this or help me do it. Yes, they can, but who are they? Well, they're going to be people who have specific kind of authorization from the FCA, and they're probably going to work in the biggest firm of accountants in your area, or a large firm of accountants, or a merchant bank, or somewhere like that. So they're basically going to be very expensive if you try to involve them in this process. So really, the entire Startup universe really lists within the third bullet point exemptions. So you're going to be okay with your financial promotions if you do it in a way that's exempt. The good news is that's fairly simple to do. The good news is you can offer shares in your startup to potential investors, but you need to comply with the exemptions, which we're going to talk about on the next slide. So financial promotions to these kinds of people are all going to be okay. So coming to the bottom one, if you're just talking to somebody face to face, or talking to somebody your accountants introduce you to, or somebody you know has introduced you to, you're going to be okay. You're also going to be okay with anybody who hits the three top bullet points. Although before you seal the deal with them and they invest in shares, you will want them to provide a certificate in which they state they are one of these kinds of people. And also to investment professionals, obviously. If you're talking to somebody who works at a VC, or even an angel club, you're probably going to be okay. So all of those kinds of people are okay. And the other thing that's going to be okay, obviously, is presenting at an organization like an angel club or investment incubator, where potential investors are invited to come along, and perhaps a number of startup companies present to those individuals. The reason for that is that the club itself should be checking that all of its members, all of its potential investors, do tick the boxes for their ability to invest in startups. And actually, the club itself should have collected these certificates from its investors. And so, if you're being cautious, you should check that with the club. You should say to them, look, you're asking me to present to these people, but are they allowed to invest in companies like mine? The answer invariably will be yes, because investment clubs and business angels clubs are aware of these regulations. So what are the sensible precautions? All of these things are fine, roughly. So running through it, face-to-face conversation is fine. If they've asked you for the information, that's probably fine as well. Presenting to a club is going to be fine. But if you're presenting to the club, double check that they are compliant themselves. And you should include really in any initial documentation your pitch deck, etc., your financial projections in your pitch deck. You should include appropriate disclaimers saying that this is a summary. Full documentation is going to be available at a later stage. You shouldn't be looking at this information if you're not a high net worth individual, etc. And also be careful about what you do with your pitch deck and how it's available to people. Don't put it on your website, I would say, not if it's too specific. Don't email it to whole groups of people. The wider you cast the net in your communications about your potential funding round, the more you are likely to fall foul of the financial promotion regulations and even the prohibition on private companies offering shares to the public. So now we've spoken about the background to your funding round and also the regs you need to comply with as part of this sales process. We can start to talk more about the detail. So where does the detail start? So you can imagine, as part of your sales process, you've gone along to your Business Angels Club. You've successfully presented your pitch deck or your elevator pitch. You've perhaps had a few conversations with investors who are interested, and then you're beginning to think about your term sheet or your offer letter and term sheet. In other words, the non-binding summary of the deal that you want to do with them, with an outline of its terms, a preliminary document, basically, which won't be binding apart from confidentiality and perhaps exclusivity sometimes. So I've described this as the next stage of the navigation, the journey, if you like. But really, of course, you should have done this before you reach this stage. Really, if you're preparing to give presentations to people and also to share your slide deck with people, your pitch deck, your elevator pitch, whatever you want to call it, really you should already have in mind what your funding round is going to look like, because as we discussed a few slides ago, you should already have done the pricing. So you should already know what you think the key terms are. So really, you shouldn't be scrabbling around actually to do this now. You should already have done it or have thought about it. You might say, well, the term sheet will come from somebody else, won't it? It will come from the potential investors. They're going to tell us how they want to invest in our company. Well, yes, they certainly will sometimes in some rounds, particularly in later rounds. But is that something that you really want? And we'll talk about that a bit more in a second. Should you not be more proactive? So what are these preliminary docs going to be? So there'll be an offer letter and a term sheet. Sometimes it's just called a term sheet. Sometimes it's just called an offer letter. But in summary, as I said, it's a summary of the deal you want to do. In the formal version, you get the offer letter, or it can come from you. So, you said you want to invest invest in our company. These are the terms of it. The term sheet's more interesting. It's the summary of the investment and what's involved, and it can be more or less detailed. And as you'll see in a minute, we very much advise more detail as being better, because we're trying to look after not just the funding rounds and the interests of the company that you're trying to negotiate as a director, but also, crucially, the interests of the founding shareholders and the existing shareholders in that funding round process. And so if you imagine it's not perhaps your first round, or it's the first, you've got a round in which you're dealing with a well-advised business angel or a VC, a small VC. Perhaps a VC is quite big, specializes in startups and scale-ups, and they find you attractive. So as part of this, those kinds of people might say to you, don't worry, we'll send over the term sheet. It's all standard, and we'll refer to our standard documents in it. So if you see this and you're thinking, well, that's quite comprehensive, isn't it? Well, the answer is no, it's not. As you'll see at the end, our advice is more documentation, not less. Where's the detail? If it's not detailed enough, you're going to be negotiating in real time, perhaps. You don't want to be doing that. You want to have prepared in advance. So what you really want is a detailed term sheet. The more detail there is, the less time you're going to have to spend negotiating, and also you shouldn't end up negotiating with investors you don't want because their demands are too great. So, and if you're the founder, the term sheet should, if the round is big enough, be very clear about the personal terms of the founders, not just the terms of the investment in the company. So, for example, if you are taking an investment from institutions and it's around where the company's big enough to think about your salary, etc., you should try to negotiate. You should be clear about what your salary is going to be, what your notice period is going to be. You should be clear about what the good and bad leaver terms are. Obviously, in early rounds, we'd say don't accept good leaver, bad leaver at all for in seed rounds. But if you're getting to a bigger round, those things usually come up. And usually you should be really clear about the fact that you don't want to have bad leaver, good leaver applying to you. But if you have to, because of a negotiation, you certainly don't want it applying to 100% of your shares. You should strongly resist this, because to have reached this stage of the business, clearly you've already put a lot of work into it, and so have the other founding team members, and you shouldn't be expected, if things go wrong, to lose 100% of your shareholding potentially. And so these aspects, thinking about your own position as a founder as well as the funding round, and making sure that they're covered off sufficiently clearly in the term sheet, is very helpful, we have found, particularly this point about good leaver, bad leaver, how much do you stand to lose? You really need to nip that in the bud. Next point really is, well, do you have an employee option pool? Are you thinking about having one? Do you already have one that you need to talk to the investors about, and so you need to be clear about it? Or more probably, if you're going to have one in the future, what's the percentage you want it to be potentially? Do you want it to be potentially to be 10 or 15% of the share capital? 10% seems to be about typical now in the deals we do. And when you're thinking about that, the investors will want to know, at least economically, who is being diluted by that option pool. Is it all shareholders, or is it just the founders? If it's just the founders, what that really means is that they will price that into their funding round with you now. Their pricing will assume, in effect, that all of the shares that could be issued in the share option pool have been issued, and they will be issued, and then they will they will adjust their pricing accordingly. Next thing is really, do the founders give warranties in the process, in the documentation? What's a warranty actually? I'll explain it to you. I'll explain it. A warranty is a statement on which somebody relies when they enter into a contract. So, for example, a warranty might appear in your subscription agreement or in your investment agreement with your investors that the company is involved in no disputes or no disputes with employees or team members. Now, if that statement proves incorrect and you haven't told the potential investors about that one big dispute you have with an employee, then that will give them the right to make a contractual claim against the warrantors, whoever they are, for any loss that's caused, if loss is indeed caused. So ideally, from your point of view, as the founders, if you're one of the founders, you should be thinking about the warranties being given just by the company, only by the company, not by you, the founders, personally, because you will remember that in this sales process, we want to limit your exposure to personal liability. If you're forced to give the warranties as a founder, you should make sure that they are limited in both amount and the time. So in other words, what does the amount mean? It means the amount of the claim that can be made from you. What does time mean? It means the period of time during which a claim could be made. And you want it to be as short as possible, 1 year, 18 months, something like that. A period of time during which the investors will know enough about the company to be able to be pretty sure that you are not in breach of your warranty. In terms of quantum, in other words, the amount that founders' warranties should be limited to, it seems to be fairly standard now to limit them to the equivalent of 1 year's salary for the founder. So from the point of view of the investors, that's not enormously high, but it's still quite high. And then finally, if the investors have said to you, oh, well, the documentation will just be in our standard terms in their opening communication with you, or they send you a term sheet that says there'll be these documents, they'll be on our standard terms. Well, I think I always like to say, well, if they're so standard, send them over. I'll have a look at them. You won't be surprised to hear that they don't appear. So if there are standard documents that the investors want you to sign up to, but they won't show them to you, that's when you need to be more detailed in your term sheet about what they're going to say. So if, for example, one of the standard documents would be your director's service contract, well, clearly you want to see it. You'd like to see it at this stage because you want to know about your salary and your notice period and other things. You also want to know about if there's good leaver and bad leaver. You'd like to see their standard articles that they've mentioned or their standard shareholders agreement that they're going to ask you to sign up to. You can ask for these things. You probably won't get them though, even though they exist. But so that's why you should insist or try to insist on as much detail as you can in the term sheet. So if that's the case, then why don't you draft your own term sheet? Well, we think it's a very good idea and we recommend it. And we think you should have been doing it actually, probably before you even, or at the same time you were thinking about your slide deck, your elevator pitch, you should have been thinking about what your term sheet would look like. Even if you don't have a formal term sheet, if you go back to the previous couple of slides that I presented, and you think about the points that I've been discussing there, you and the founding team should probably sit down and think about the terms that were going to be acceptable, not just to the company, but to you as a founding team in relation to the funding round. And so the term sheet, your term sheet, might remain an internal document if you're not in the position to drive the term sheet stage. But I certainly think that in seed rounds, you should try to drive the term sheet stage. In a sense, it will be more informal at that point, but it might just be an email to the people you know who are interested in investing. Just setting out clearly what they're going to get without and making it clear that the thing they're going to get is limited to that list of things to avoid people trying to negotiate in more rights than you would like them to have. And so that really is the point that's made there in the bottom bullet point. So early rounds, you want to be fully in control, be clear that people are just being asked to invest and sign up to your shareholders agreement, which ideally won't give them any rights at all, pretty much. And then on later rounds, you're more in the realms of negotiating with your investors, and the bigger the round and the more money they put in, the more you are in the realms of trying to understand your position and negotiate the best deal you can for yourself and the company without controlling the process. So we've reached this stage. We've now gone beyond our initial pitching to the investors in the investor club, or talking to the group of people that our accountants found for us who might be interested in investing. And we've we've fleshed out the proposed investment that they're going to make in the term sheet. There's perhaps been some back and forth with them. And so we know what the deal now is going to look like. And so we now have our funding round structure described in the term sheet. We've got the sufficient detail because we didn't go down the path of saying, oh, it'll all be all right, we'll sign up to your standard forms, Mr. Investor. And so we're now thinking about what the actual documentation will look like and how that tends to vary between funding rounds depending upon their sizes. And I think that most of the documents I describe will probably be familiar to you. And we talk about how different funding rounds take place these days. So just generally raising capital and investment from founders themselves and in internal external investors is equity. Now equity investment is basically investment in shares. If you're the founder, I've spoken about this before, but the temptation is sometimes to sit there and think about, oh, I don't want to give away too many shares in the company because then I'll be diluted. But it really is a bad mindset to have, we think. And the reason for that is that, as we're saying, as I'm explaining, it's a sales process. And so you as a director are causing the companies to sell to people who are investors shares in the company. And so you shouldn't be doing that at all if you think you're not getting value for money, or the company's not getting value for money. And if you think that you're getting too diluted, then you'd have to question, I think, probably whether your original pricing and projections for the company were right. So the company value were right. So going right back to the beginning, before you start on this journey, you should really have done proper pricing for the round so that you're happy with it. So really, by the time you're at this stage, you're not sitting there thinking, oh no, I'm going to be diluted too much. If you are, there's a problem. You should have thought about that before at the outset. But also generally, as you've gathered, as directors, wearing your director hat, going back to the second or third slide, you shouldn't be thinking about it in that way at all. You should be thinking about the company and the money that's coming into the company to make it grow. And the reason why dilution shouldn't be an issue is that what you're setting up is a situation where you used to own pretty much all of a tiny pie, and now the pies are much bigger and you own a smaller slice of it, but that slice is still should be more valuable than where you started with, back in the situation where you had complete control. So in early rounds, where's the money coming from? Mostly founders, family and friends, and then other bigger seed rounds, perhaps business angels and high net worth individuals. And also, of course, sometimes it's coming from crowdfunding, which we'll talk about. Used to be a novelty and now, of course, isn't. What is it? It's managing the process of investment via web platforms. So the funding rounds usually go through this series of rounds, if you like, or these are the islands we're voyaging between, if you like, if you want to go back to our navigation metaphor. So at the start, you've just got the founders' shares, and probably at the same time or just after, you might get this idea of sweat equity. Well, what's that? It's when you've agreed with somebody that they will get shares if they do work for the company, as in effect a form of payment. And that's usually because the company's bootstrapping. You don't have enough personal money, nor does the company. So it's the only way of moving forward. And those team members may be part of the founding team or maybe slightly outside the founding team. What's the trick with them? The trick with them, as I've said, is not to undervalue the company and therefore end up in a situation where they own far too much of the share capital. That's the main trick with them. Moving on from there, you'll have seed rounds. Seed rounds should have simple documents. Founders should remain control. As you get to bigger seed rounds and the A rounds, well, the founders are usually going to lose control of the company and sign up to negotiated agreements. Crowdfunding. We'll touch on this very briefly. I don't think there's any point describing this anymore because everybody knows what it is. But what are the key things really about crowdfunding that you as a founder considering organizing your funding round or part of your funding round in this way? What are the key things you need to know about it really? Well, I suppose there's a third thing that's not here. We're assuming in this slide that you're talking about crowdfunding, which allows money for shares, because that's what the whole talk's about. Obviously, the whole webinar is about old style funding rounds, invest money, get shares, or if you're the company, accept investment from investors, issue shares to them. There are other kinds of crowdfunding, but they're not covered by this talk. So we're talking about the shares kind of crowdfunding. So what do you need to know? It's really just these two things. It's really how much is this going to cost you? In other words, how much of the money you raise is going to disappear in fees to the crowdfunding platform? And if that's going to be acceptable to you, that's fine, but you need to know what it is. And the other thing is, how do the terms and conditions work? Particularly in relation to small investors. Imagine that I'm a small investor and I can invest £5 and get some shares in your company. You might say, well, that's great if there are enough of you. Yes, of course, that's true. But you don't want me directly on your cap table. You don't want me in your register of members as a shareholder, because one of the jobs of the directors is to communicate with all shareholders. For a startup or a scale up, you don't want too many shareholders, basically. And the great thing is most crowdfunding platforms allow you to set this. So small investors won't be representing themselves when they invest in the company. The crowdfunding company will have a nominee company representing the small investors. So on your cap table, in your register of members, you'll just have the nominee company as a holder of however many shares on behalf of its small investors. What are typical examples of crowdfunding platforms? Crowdcube and Seedrs. There are others, but they're pretty big ones. So it's easy to check out how they operate. Do check out these things though. So what the platforms do? They really just organize the mechanics of the investment round for you. Some of you will be sitting there thinking, well, Mark's just said that you can't offer shares to the public. You have to comply with these regulations, the financial promotion regulations. If that's so, how does crowdfunding work? Because surely it's offering shares to the public, isn't it? Well, you'd be right to think that, actually. And the reason it can work is because crowdfunding platforms have set themselves up so they kind of function like clubs. You have to sign their terms and conditions as an investor or as a company. And in that way, they can argue that they are not offering shares to the public, just a subset of people who are interested in this behind, if you like, the confidentiality and sign-up terms of their platform. And they will have taken legal advice and have legal opinions which state that what they are doing is compliant with the regulations. And if they had not done that, they wouldn't have survived so long. What do I think about that? Is that the future? Is that the way forward? I think probably not. I think that it needs to be easier for people to invest in startups. It really shouldn't be so difficult in a situation where it's very easy to exist in something that's far more risky, which is cryptocurrency, for example. It should be easier to invest in startups, although there will, of course, needs to be controls on it. And I think that the law will be reformed eventually in order that the crowdfunding platforms don't actually need to have such convoluted structures. So what's the documentation? Now we've talked about the kinds of funding rounds and how they're organized. We should talk about the detail. The detail, well, what do they do, I suppose? Well, the documents are going to draw a line under what's gone before. They're going to seal the deal. They're going to look back in time at the process that's happened and all the conversations you've had with your investors, the term sheets, everything you've ever sent to them, every single email, every single telephone call, and they should draw a line under it all. And all of these documents should include these things, which are covered by the bullet points. And any that are professionally drafted, or you or your investors sign up to via a crowdfunding platform, indeed, will include these clauses. But if you're thinking about bootstrapping and doing it yourself or something like that, make sure that you do include these. Obviously, I'd like to hope that you're going to be speaking to solicitors about these things. Coming to the final bullet point, if some of your investors are high net worth investors, etc., the kind of people we spoke about, when you in the documents that you're putting in place in front of them, the subscription agreement, one of the things they're going to need to subscribe to provide to you is the investor certificates that they should have or told you they would have. And where do you get these from? These are standard forms which are available from the I think it's actually from the website that talks about the financial promotion regulations themselves. You can certainly just download them, the forms of certificate. The deal documentation itself, well, what's it going to be? It's going to be a shareholders agreement and or a subscription agreement. Sometimes the subscription agreement is called an investment agreement. Don't really get too hung up on the names of these agreements because they change depending upon the deal and who you're dealing with. In an early round, you're probably going to get a shareholders agreement and a subscription agreement or subscription agreements, or perhaps you might call it an investment agreement. What do the documents do? Well, basically, you've got one part which deals with ongoing relations, call that the shareholders agreement, and you've got another one which deals with the terms of the deal itself. In other words, we're going to put in this much money and we're going to get that many shares. These are our rights. You want obviously to keep the rights to a minimum, but there may well be some. And so ideally, it's best to have these two things in separate documents, not in the same document. Sometimes you see a shareholders agreement, which is also a subscription agreement for a funding round. So you have the whole thing mixed in together, the ongoing relationship and the details of the round. Well, that's great for one round, perhaps for your seed round. But when you come to do your next round, you're going to be asking your new shareholders to sign up to a shareholders agreement which has a load of irrelevant information in it relating to the funding round. So try to keep these things separate, and you're going to have these things in addition to or instead of the articles of in addition to the articles of association, put it that way. And you will have more or less changes to the articles of association depending upon who you're dealing with, who your investors are in the round. Early rounds, you shouldn't really need to touch the articles of association. Some legal rights and obligations are better in the articles of association, and investors know that. So the bigger the round, the more sophisticated your investors, the more they're likely to insist that you amend the articles of association to include certain things. The deal documentation, crucially, needs to cover all of the normal shareholders agreement type points. So the relationship between the board and the shareholders, for example. Are there certain things the board can't decide without going to the founders or the majority of the shareholders, or a majority of the shareholders that must include the founders plus a majority of the investors? You get all kinds of complication. Things like what happens if a founding shareholder, passes away, or is too sick to work, or not performing, or they just walk out. People fall out in startups, unfortunately. And this is where you as a founder might actually, or a founding team might actually want bad leaver and good leaver to apply to you and team members during the initial phase of the company's growth. Certain decisions will be reserved for a group of people, usually in early rounds, the founders. but then it could be the majority shareholders. As I said, think about how that's going to be defined. What does it mean? And the mechanism for direct investors subscribing themselves, the mechanism for investors subscribing for shares is probably going to be in a separate agreement. So it's going to be in the subscription agreement. The subscription agreement might be called an investment agreement. And so, as I said, don't worry too much about what it's called. If it's in a round with sophisticated investors, it's going to be investment agreement. It's the basis on which the investors subscribe for the shares, and it deals with the mechanics of the investment. This is the thing. This is the agreement where the warranties will appear. Remember, we spoke about the warranties when we were speaking about the need to control the term sheet, the need to have made clear what's acceptable and not acceptable, and the way in which warranties can reintroduce personal liability, or a limited form of personal liability, hopefully. The personal liability you sought to control by incorporating the company as a private limited company and running it as one in the first place. So the warranties may appear, and if they appear, this is where they're going to be, this is where they are going to appear. Ideally, they should just be given by the company, but they may be given by the company and the founders. As I've said, you should seek to have them limited in amount and in time. So yikes, what are warranties? This is a good explanation. The reason it's useful to have it is because often if you're not familiar with legal documentation or funding rounds, when you hear the word warranty, you think, well, that's the thing that gives me the right to return the bicycle I bought for my son if it doesn't work. That's an entirely different use, really, of the name. So what is a contractual warranty? A contractual warranty is a statement that induces somebody to enter into a contract. And you remember these documents draw a line under what's gone before. You'll remember that we've said that the documents, the deal documents, are in effect the universe of the deal, no matter what went before. So the warranties and any disclosure against them are going to apply because they are in the deal documentation. And so if you are giving the warranties, they are going to apply. You need to think very carefully about what they say and whether you need to disclose anything against them. In our example from before, disclosing the fact that actually there is an ongoing dispute with one of the employees, and providing sufficient detail about it, because at this stage what it is allowing the investors to do is to potentially renegotiate on price, even if they're not happy with any disclosures you make against the warranties. And as you can see here in the second bullet point, the warranties reintroduce potentially personal liability, the personal liability that you're trying to avoid. So in a way, I could say, oh, that's the end of the tale, really, because after the last slide, you're at the point where you've signed your documents for your particular funding round, and you're into the post investment tidying up of issuing shares and share certificates to people. And if you like, you've reached the destination of your navigation. You're on the new island. The new team members have joined. They've paid up. They've got the agreed ownership rights in relation to the company. They own their percentage of the shares. You've been diluted and the other shareholders have been diluted. You're all sitting there happily because you own you've only got a slice of the pie now, but you think it's worth more than it was before. And so wouldn't this be a moment to draw a line under the presentation and say, well, that's an overview of how to navigate some of the things in funding rounds. But no, I think it's probably worth going back to the beginning. And at the beginning, I was talking about, well, funding rounds. What if it's not your first funding round and you've already got shareholders and investors from a previous one? The first thing you should do actually is look backwards, look in the rearview mirror, check your agreements with them before you sail off on the next leg of your journey seeking investment. And so let's say we've just closed our funding round and we're looking forward to the next period of trading of the company with the funds it now has to, say, build out its marketing and marketing function. Let's say that that's what you've got the money for, and that's why the investors invested. You're going to be able to get a bigger market share because of the money you've received from the investors, and they're pleased to help you grow the business in that way with their money. But now you've got these people on board, and you've spent a long time talking to them. They may have more or less rights in your agreements that you've agreed with them. And as I've suggested, the bigger the funding round, the more likely they are to have greater rights rather than fewer rights. But whether they've got fewer or greater rights, you do need to keep these people on board, as it were. You don't want them jumping ship or wishing they'd not joined the ship. And so try to make an effort to keep investors involved. They are now your shareholders, after all, not your investors. Newsletters, updates, webinars, Q&A. It's in the best interests of the founders and the company for you to do that. Try to respect their confidentiality. Sometimes you might not be sure whether you should use BCC or similar. A lot of the time, probably by the time you reach this point, everybody's got each other's email address anyway, so you shouldn't be perhaps overly concerned, but do try to respect confidentiality. But all of these things, if you can communicate with your investor, your shareholder base, outside the founding team, outside the people who are working on the project day to day, so who know what's going on, it will really help you when you come to broach the issue of your next funding round, because they'll probably have heard a bit about it in advance, perhaps in relation to one of your newsletters. You can start to warm them up to it in your newsletters or your update emails. Some of our clients, even for fairly small companies, are absolutely excellent at this. Others are much worse. So I'm hoping that in your funding rounds, you're going to fall into the absolutely excellent category and communicate really clearly with your new shareholders, because after all, they've invested not only their money, but also their time and their kind of their interest and their faith in the company. They want to know how it's doing, and making them feel close is a good way of, in effect, managing them as you build up to your next funding round. So thank you very much for listening to this webinar. And in summary, I think that founders need to balance the desire for control, which is natural, with the need for funding and perhaps therefore losing some control. And also, as I've said, through these funding rounds, the degree of personal risk they want to take. Or if you're forced to take personal risk, at least understanding what it is and trying to limit it. If you want more information, of course, there's our website, and we'll be following up after the call. So thank you very much indeed for listening to me as I gave this presentation.